one of our golden rules is not to fight the Fed. And right now, the markets are doing just that. And I think it's a mistake.
I think there's look, I'm realistic here. I mean, I'm not going to tell you there's no risk of a recession. I think there's a 40% risk of a hard landing and a 60% likelihood of a soft landing.
Consider that equities are super cheap. And yes, earnings can fall a little bit more, but you're never going to time the bottom.
This is Bloomberg Surveillance, Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
10 a.m. in London, 5 a.m. in New York, 6 p.m. in Hong Kong. Our top stories today. The worst year for global stocks and bonds in more than a decade is finally coming to an end. Equities have lost around a fifth of their value as inflation has forced yields sharply higher. Commodities, though, have outperformed with energy prices soaring. Traders are now watching China's reopening to see if demand will pick up further in 2023. And this year's crypto collapse is not over yet, as revelations emerged that Sam Bankman-Fried met with top White House aides just before his empire fell apart. Welcome to Bloomberg Surveillance, the early edition. I'm Guy Johnson in London with Kriti Gupta and Kailey Leinz in New York. Anna Edwards is off today. Matt Miller co-hosting Surveillance in the next hour with Kailey and Lisa. Kailey, let's talk a little bit about the Asian session today and the bigger picture for Asian markets. Have they outperformed or underperformed this year?
Interestingly, they did outperform global stocks this year, but that still means a 19% decline and the worst year since 2008. So outperformance definitely a relative term as we consider the year that was. I think I speak for a lot of us when I say I am so glad we only have one more day to get through, just one more trading day of 2020, at least for the West. We already are through with the year in Asia overnight. That said, it was a positive last day of the year. The MSCI Asia Pacific Index as a whole up by about 0.4%. And Chinese stocks as well, which actually only had their worst year since 2018. The CSI 300 up about 0.4%. The market really trying to weigh optimism about the reopening and growth story on the one hand, with pessimism about the surge in COVID cases that could get worse over the Lunar New Year holiday. Now, in addition to COVID zero and other factors in Asia specifically, globally, markets have had to consider the tightening of central bank policy this year. But of course, the one central bank that really sat that out was the Bank of Japan. They're still dovish, and yes, they did tweak yield curve control, and they are fighting very, very hard to defend that curve control because the bond market continues to test them. And as a result, unprecedented move for the third day in a row, the Bank of Japan conducting unscheduled bond purchases. They actually purchased the most bonds on record in the month of December. So we saw that 10-year JGB yield moving down by about 4 basis points to 42 basis points, so below that half percentage point cap. And then interestingly, as you have the Bank of Japan continually coming in and buying bonds, the Japanese yen is the outperformer on the day against the US dollar, stronger by about 0.8% to 132, but still the yen by far the weakest G10 currency on the year, Kriti.
Yeah, Kailey, that green on screen that you're seeing, at least in the equity space in the Asia market, has not translated to futures action here in the States. In fact, you are seeing futures take a little bit of a step lower, down about 0.4%. And it's not just the stock market here, it's the bond market as well that you are starting to see a little bit of sell-off. Yields up only about 3 basis points. Remember, in the context of this kind of extremely volatile year, 3 basis points is almost nothing, but still significant given that we haven't really seen a 3 basis point move all week long. So 384 on the 10-year yield. And once again, it sticks to commodities. It almost feels like the commodity market or the bond market is kind of taking its cue from each other. So NYMEX crude trading at a 77 handle, down about 0.7%. That's going to be a crucial story going into 2023. Whether or not the tail wagging the dog isn't the bond market anymore, maybe it's the commodity market that then affects the rest of the cross-asset story. And of course, Bitcoin probably following in to that theme where Bitcoin is actually down about 0.5%. It's interesting, Guy, that I don't feel like there's any real move outside of saying it's the last trading day. Maybe people are cashing out, maybe some rebalancing on the books today.
Yeah, I think a lot of people may be staying at home today, waiting for the long weekend. Kriti, let's talk about what is going on today in Europe. Now, as you can see, we are red. As Kriti says, though, I'm not sure there's much of a signal from this. I think this will be more useful as a weather map. It is unbelievably warm here in Europe right now. I'm going to talk about the gas price in just a moment. It is going to be T-shirt weather in Berlin this New Year's Eve. And that is great news for Europe. And as Javier Blas points out in his column today, bad news for Vladimir Putin. The story this year in Europe has been about the war. It's been about inflation. It's been about the energy crisis. The stock 600 down by 0.4% today. It's down around 12% year to date. Now, you do need to currency adjust that. Energy's been the bigger outperformer this year, plus 25%. Real estate has had the worst performance in terms of the sector story. The outperformance in terms of single stocks, Rheinmetall, which builds tanks out of Germany. Obviously, that's related to the war. The standout story for me on the downside, though, this year has been Credit Suisse, which is down nearly 70%. Year to date, 60-something odd percent. It's had a terrible, terrible year. In terms of nat gas, let's talk about that. Today, down another 5%. As I say, it's incredibly warm. This month alone, we have seen the biggest drop ever for European natural gas. That's the Dutch contract. We're down by nearly 45% as it's got warmer and warmer. The gas price has absolutely tumbled. And then we come back to the inflation narrative, which is so related to what has been happening with the energy story. Spanish inflation today coming through year on year at 5.6%. That's the December number, 5.8, below estimates. How quickly inflation falls in 2023 is absolutely the key question that we need to be asking, Kailey.
Yeah, it's about the downward slope in the new year, but it was all about the upward slope of inflation in 2022, which, as we've said, marks the worst year in more than a decade for global equities and bonds, with stocks facing a 20% fall year to date. Ed Yardeni, president of Yardeni Research, says the stock market bulls may face another challenging year ahead if the economy stays strong.
The key is that kind of narrow path where inflation comes down quite a bit more than is widely expected. That's the camp I'm in.
Joining us now for a look back on the year is Bloomberg Markets reporter Justina Lee. Everyone coming out of this year battered and bruised, Justina.
Right, exactly. I mean, hindsight really is 2020. I think investors, when they look back on this year, will think that the big mistake they made at the start of it was underestimating how sticky inflation was going to be and how determined the Fed was going to be in fighting that. And I think as we head into the new year, they're also wondering if they're going to make the same mistake again, with talks of peak inflation again. But it could also be an opposite scenario where the monetary tightening starts to show up in the economic data and growth does start to slow. I mean, either scenario is not great for stocks, but I guess in the latter scenario, if we do get something that looks like a recession, it could at least mean, some reprieve for bonds.
Justina, a trade that has worked for, I want to say, at least 9 out of 12 months of the year has been a bid into the strong dollar. But I have to ask, going into 2023, given that terminal rate expectations are stalling out for the Federal Reserve, what is the bull case for the dollar?
Yeah, it does go back to what the Fed is going to do next. But of course, currencies are relative. And so we also have to look at what other central banks do. We've already seen the dollar take a bit of a hit finally recently because of the BOJ turning just a little bit less dovish. And now there are speculations that maybe they're heading further in that direction. But at the same time, we have to look at what the ECB is up to. And they've always seemed a little bit more careful about raising rates. And with inflation coming down, out of the Eurozone, I mean, there are questions over whether they will catch up with the Fed at all.
Justina, thank you very much indeed. It's been a brutal year, as Kailey says. Let's see what 2023 brings. Have a very happy new year. Justina Lee. Let's turn to tech. Tech has been battered this year, with the NASDAQ 100 basically falling circa 35% and a big underperformance coming through as well. Ed Ludlow joins us now for a deeper dive. Ed, give us the kind of more nuanced picture here. Tech has had a tough year, but it's not been all tech being treated equally.
Yeah, that's a fair read. I would say that, big tech's collapse is kind of the abiding market theme because it came as a consequence of everything we saw from central banks and the global economy. Yes, you look at the NASDAQ 100 down 35 or 32-ish% year to date. Even worse, underperformance in that basket of mega cap tech stocks. There's some distortion on the NYSE FANG Plus index because it includes the US listed shares of Chinese tech companies, which have their own story. Semiconductors also moving so quickly from supply constraints to a supply glut, something that we didn't think would happen, this return to a boom and bust cycle for the chip sector. This was the worst year for the NASDAQ 100 going back to 2008, but it's interesting that it was also the worst year for the Nasdaq 100 relative to the S&P 500 going back to 2002, 20 years. Energy is a big part of that story, right, Guy? You look at the big performers on the S&P 500, they are energy companies. The market just was wrong, basically, about inflation and the Fed, just like Justina was talking about, right? We hit a new low on the Nasdaq 100 just 2 days ago when the Fed had its latest decision and projected rates at 5.1% by the end of next year and potentially cutting down to 4.6% in 2024. The market realized there's further to go with this, and it's not now just that rates discount the present value of future profits for tech, these higher multiple stocks, but now we're worried about an earnings and an economic recession. You know, we've kind of given up on the idea that some of those names on your screen, despite strong balance sheets, will weather the storm. Tesla, a big part of the story, of course, specific to Musk's purchase of Twitter, the kind of brand reputation hit that stock's had because of Musk's behavior on the platform, but it too is a higher multiple stock. And when you look at multiples now, forward 12-month price to earnings relative to where they were after the dot-com bubble, there's not a huge amount of optimism going into 2023. Also some pandemic darlings there. Zoom, they were some of the big stories, the collapse of those pandemic darlings this year.
Well, and Ed, we know that historically there is a very close correlation between the performance of tech stocks and the performance of cryptocurrencies, which haven't just fallen victim to the multiple compression and the idea of tighter policy, but also the implosion of so many players in the industry, including FTX. And on that note, in the Bahamas, authorities now say they seized $3.5 billion worth of digital assets at FTX shortly after the crypto exchange filed for bankruptcy protection. The Bahamas Securities Commission cited a risk of, quote, imminent dissipation of the assets. That was based on information provided by founder Sam Bankman-Fried. So, Ed, just walk us through this in particular, but also just the chaos we have seen in crypto this year.
Well, you got it exactly right. This year, we've been so focused since November on FTX and Sam Bankman-Fried. You have to extrapolate the year as a whole. We started 2022 with the total market value of global digital assets at $2.5 trillion. They dipped below $1 trillion by June, and you have to remember what happened in May, the collapse of Terra USD, some of the regulatory actions and investigations that took place earlier this year. That's a fantastic chart of Bitcoin, right? You go back to the beginning of 2022, the trough that we hit very recently was driven by FTX. But Bitcoin itself was also not immune to the actions taken by global central banks and higher rates as well. We're down 60% year to date on Bitcoin. It is the biggest single digital asset by market value. The other area I'd look at as well is crypto-related stocks, Coinbase being a great example. We talk about the declines on Tesla, but look at Coinbase. Part of that is the contagion. It's crypto winter and contagion with the two buzzwords. But frankly, we saw investors pulling out of digital assets when things got a bit hairy. You also look at those others that basically have a direct interest in Bitcoin through ownership, like MicroStrategy or Riot Blockchain, which is a bet on the underlying technology. And they too, those are severe underperformances of Bitcoin, probably. I mean, that's a disastrous year for crypto-related stocks.
Yeah, I think that probably is a fair way of putting it. Ed, very nice. Thank you very much indeed. Bloomberg's Ed Ludlow. Turning now to China. The COVID surge there threatening the economic recovery. Bloomberg's Tom McKenzie joining us now with some startling estimates of just how bad this COVID outbreak could be. Tom, let's talk a little bit about the projections that we're seeing right now. Affinity's out with some fairly bleak ones. I'm struggling to get my arms around the data. Just sort of update us on where we are.
Well, it's interesting. There's always been skepticism about the data coming out of China when it comes to COVID. Some of that skepticism unjustified up until now. Now they are not doing the testing. They're not publishing the results in terms of infections or death rates. So that skepticism is very on point at this point. What we're seeing in terms of research and the data that's coming out, one firm, Affinity, based in the UK, pulling the data sources that they have together to project that over the long term, over the next at least few weeks into the middle of January, I should say, you're going to be seeing as many as 1.7 million people who are dying as a result of this. 3.7 million daily infections. Currently, they say about 9,000 people are dying per day in China, and they see that radically increasing to 25,000 per day by the middle of January. That coinciding with the Lunar New Year holiday, which is typically the biggest mass migration of people on the planet. So the personal toll, the societal cost now of this decision to walk back radically from COVID zero is being felt across China. And then when it comes to the economics, some of the early data suggesting that in cities like Beijing, there has already been a peak and you're seeing mobility pick up. That's the bright side in terms of the economic implications. But the broader picture across the country is that human toll right now.
So let's go from the economics to the financials of it all. How does this really set the stage for a turnaround in Chinese assets?
Well, is China going to be the big macro story of 2023? Some people think it will be. Of course, Wall Street banks lined up at the gates at the outset of 2022 to predict some pretty decent upside for Chinese equities. It hasn't worked out like that, of course. The MSCI China index is down about 21% year to date. Yes, in the last 30 days or so, you've seen a 35% rally, but year to date, it's down about 21%. The yuan is down about 9%. In terms of foreign inflows into Chinese equities, at a record low for the year, about $12.5 billion US dollars. Four key things, of course, four key factors that have weighed on Chinese assets over the year. Of course, COVID zero, but also the crackdown on technology, property, and the softness when it comes to exports. Arguably, COVID and the restrictions there, you can put that one to one side by March or April of next year. But exports could still be a lag. What happens when it comes to property? That makes up about 20% of GDP. And when it comes to the technology sector, so important for jobs growth in China. And don't forget, amongst 18 to 25-year-olds, you've got about 20% unemployment. So you're looking at all of that into 2023. Morgan Stanley, though, and Goldman Sachs both see upside for Chinese equities into, by the end of 2023, 14% upside from Morgan Stanley. That is the forecast, 16% from Goldman Sachs. And they think that foreign buying is going to pick up from $12.5 billion this year to about $65 billion by the end of next year.
As you speak, headline crossing the Bloomberg, offshore yuan extending gains versus the dollar to the strongest level since September the 13th. Maybe an indication of some of those flows. Tom, very nice. Thank you very much indeed. Bloomberg's Tom McKenzie. Coming up, Alan Custis, Lazard Asset Management, head of UK equities. We'll get his take on the year ahead. Where do you want to be putting your money to work? And are debt investors actually growing more confident in the Fed's ability to contain inflation, to deliver a soft landing? We're going to speak with Bloomberg's Editor-In-Chief Emeritus, Matt Winkler. Plus, New York's first legal marijuana dispensary is now open for business. Details to follow. This is Bloomberg. So this is Bloomberg Surveillance, the early edition. I'm Guy Johnson in London, Krithi Gupta and Kailey Leinz, both in New York. Let's talk about commodities. Oil set to end the year modestly higher. It has been, though, a volatile year. Investors are looking for an expected rebound in Chinese demand next year, maybe to continue that trade. Joining us now is Eddie van der Volt, Bloomberg Market Live Deputy Managing Editor. Eddie, a lot of assets have been battered this year. Commodities, though, have been the real star.
Yeah, absolutely. Oil, as you said, doing well. But I think that's partially because oil had OPEC on its side, right? There was a lot of talk about cuts. Now, the cuts that OPEC advertised was not as deep as the ones they actually delivered. But just the fact that somebody is managing supply helped an awful lot. You didn't have that in other assets. The other thing is, of course, you had that disruption in Russia and in Ukraine. And that, of course, just added a wild card. And now, as we get to the end of the year, you're suddenly starting to hope for a Chinese bid coming back into the oil market and movement in China. And I think all of those factors meant that oil has done particularly well, and therefore commodities broadly has been kept supported throughout the year.
Eddie, are commodities still the go-to hedge, or should they be in 2023?
Yeah, it's a bit more nuanced as we go into next year, right? I think other assets start to come back a little bit. I think the oil market, I do think that the OPEC bid in the market will help support prices into next year. But I think you want to look more broadly than purely going into oil. I think copper probably comes back a lot stronger. That copper underperformed this year versus other commodities, and it's down on the year. But I think as we go into next year and you see Chinese demand coming back and Chinese manufacturing picking up, I think we could see copper outperform. But the big one, I think, is gold, particularly for the first few months. As China gets ready to celebrate the Lunar New Year, I think gold could do particularly well.
All right, Eddie Vanderwalt of Bloomberg Markets Live, thank you so much and Happy New Year to you. And for more market analysis as we close out the year and ahead in 2023, check out MLIV Go on your terminal. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Kriti Gupta in New York and Guy Johnson in London. Now keeping you up to date with news from around the world, here's the first word. The U.S. may give Ukraine's ground fighting capabilities a boost. Bloomberg has learned the Biden administration may send Bradley fighting vehicles to Ukraine as part of another military support package. The Bradley is used to transport troops, but it's also armed with missiles and a 25-millimeter gun. The Bank of Japan has never done this before. For an unprecedented third day, the central bank has made unscheduled bond purchases. The BOJ is fighting against speculation that it's about to end its super accommodative monetary policy. It's bought a record $128 billion of bonds this month. After a week-long meltdown, Southwest Airlines plans to return to a normal schedule today. Thousands of Southwest passengers were stranded across the U.S. because of cancellations caused by winter storms and overwhelmed technology. The carrier scrapped more than 13,000 flights in the last week. And he was called the King and has long been regarded as the best player soccer has ever produced. Brazilian star Pelé died Thursday after a battle with cancer. He led Brazil to 3 World Cup championships, and later in his career, he moved to the U.S. to play for the New York Cosmos, fueling new interest in soccer by Americans. Pelé was 82.
This is Bloomberg Surveillance, the early edition, and here's what you need to know. The worst year for global stocks and bonds in more than a decade is finally coming to an end. Equities have lost around a fifth of their value as inflation has forced yields sharply higher. Commodities, though, have outperformed with energy prices soaring. Traders are now watching China's reopening to see if demand picks up further in 2023. And this year's crypto collapse not over yet, as revelations emerged that Sam Bankman-Fried met with top White House aides just before his empire fell apart. I'm Guy Johnson in London. Kriti Gupta and Kailey Leinz are both in New York. Anna Edwards is off today. Matt Miller is going to be co-hosting Surveillance in the next hour with Kailey and Lisa. Kriti, last day of the year. We're nearly done. What does it look like?
Almost there, almost done. Well, not very good when you're talking about risk sentiment. You are seeing a bit of red on the screen when you look at futures trading. You are seeing futures down about 0.3%. I will say perhaps the selling is a little more muted, obviously, on this holiday trading week. And you also, of course, have the 10-year yield, 3.84. So the bond market is selling off a little bit too, perhaps not by the same margin, but you are seeing yields higher by about 3 basis points. Crude is no exception. We are now at a 78 handle, only down 0.2%. So I think what's interesting in the last 30 minutes since we did our last market check is simply that futures were down a little bit more. They're starting to pair some of those losses, but still, we still have ways to go before potentially turning green on the screen by the opening bell. So right now, risk sentiment down across the board, including with Bitcoin, Kailey, down about 0.5%.
Well, we know Bitcoin has had an incredibly rough year, down more than 60% over the course of 2022. And you know what else is down more than 60% over the course of 2022? Tesla, worst year on record. It is about to close out, and yet it does look like it's going to end the year at least on a slightly more positive note, recovering some of those losses. It's actually up 12% over the last 2 days, the best 2-day streak or 2-day performance going back to May. And we are extending gains in pre-market trading up about 0.6%. But I do not doubt that this stock is going to be one we continue to watch throughout the course of the year ahead. And of course, Tesla was a bit more overdramatic, but by and large, it was just a bad year for large cap technology stocks. Apple is down 27% on the year, both Amazon and Nvidia down by 50% each. And as we look to close out what has been a brutal 2022 for these names, all those stocks are also lower this morning to the tune of about 1/4 to 0.5%, Guy.
Let's talk about what's happening here in Europe. The Stock 600 is down circa 12% for the year. There's big sort of divergences, though, between European bourses. The best performer, Rheinmetall, the armored personnel carrier, maker, the tank maker out of Germany. That's the war story that is impacting the market. At the bottom end of the market, it's the rate story. Real estate, the worst performing sector. Credit Suisse down very, very hard this year as well. That's one notable story out of the banking sector. But European equities today down by around 0.4%. The gas story absolutely front and centre. It is quite warm here at the moment. I hear it's going to be T-shirt weather in Berlin this weekend. Over the last month, European nat gas is down by 45%. That's the biggest drop ever that we have seen there. We're almost halfway through the winter. I think January the 15th is the halfway point. And it's looking good. Bad for Vladimir Putin, better for European consumers and industry. And the Spanish 10-year up by 300 basis points this year. We've seen the ECB hiking rates, but inflation starting to roll over, particularly in Spain. The expectation was that the December number would be 5.8. It actually came through at 5.6. We'll take the good news where we can find it, Kailey.
Yeah, so maybe the good news is what central banks are trying to accomplish is starting to get closer to being accomplished, but if we listen to them, they say they still have a ways to go. So what does that mean for the outlook going forward as we round out this year and look ahead to 2023? Joining us now to discuss that is Alan Custis. He is Lazard Asset Management Head of UK Equities. Alan, great to speak with you. Happy almost end of a brutal 2022. As we look ahead to 2023, how much is going to be dependent, as it was this year, on central banks tightening, and how much is it going to be a return to the fundamentals and the outlook for the real economy?
Yes, great question. Morning. I think you have to go back to the experience of 2021 when the central banks were a bit in denial, I think it's fair to say, around inflation. Remember, the narrative was this is transitory, this is transitory. And obviously it didn't turn out to be as transitory as they thought it was going to be. And I think that as we move into 2023, one of the biggest risks I see is that actually the Fed, the ECB, and to a lesser extent the Bank of England actually over-tighten. Because as we've been seeing, the Spanish inflation data came in lower. We're looking at the gas price down materially. There are clear evidence that inflation has peaked. We think it's going to fall, but it's going to fall slowly. And the key will be for the central banks to manage the narrative around that and not over-tighten. And clearly, the experience of the last couple of weeks when the dot plot went to 5.1 has clearly rattled the market again. I think it's very important that the central banks recognize that inflation is falling, and just to keep the cooker on simmer rather than trying to overclub it at the moment. And as an equity investor, for me, that's going to be the key call in the first and second quarter of 2023.
Alan, let's talk about your bailiwick. Commodities have done well this year. The FTSE 100, by extension, currency adjusted, has been a big outperformer. Does it continue to deliver in 2023?
I think it does. I think it's going to be a year of two halves. I think the first quarter is probably going to be the weak point for the domestic market. If we think about the domestic market being the mid 250, the small cap end of the market, that's clearly had a very tough year. So I think for investors, the first half of the year will be about sticking to the large cap names. As we've talked about, China is showing signs clearly of reopening. That supports, some of the commodity prices. That's supportive for large cap over mid cap. The other area which I think will continue to perform very well into 2023 is financials, particularly banks. If we don't think that rates are going to go to sky high levels, then banks are actually in the sweet spot at the moment with net interest margins being at very manageable levels without the risk on credit. So I think that all that leads to, yes, large cap over mid cap. But I think as we move towards what will inevitably be a pivot that the market identifies mid-year, then you will be looking to switch into some of the more domestic names.
Okay. How big an outperformance do you think you get relative to the 100 from the 250 at that point? At the moment, you've got the biggest outperformance in 2022, FTSE 100 to 250 ever on record, Alan. So once that starts to close, how quickly does it close?
I think it closes quite quickly, and I think that's a trade that will happen in the second half of the year, and therefore, investors should be thinking about it in the second quarter. The risk of going too early is that we get, going through January, February, March, when we've got a further hike in energy prices, or the cap, I should say, Also, people will continue to look at unemployment data, house prices a week. So the consumer domestic outlook, I think, is quite dull for the first 3 to 4 months. But I think there's certainly the point in March, April, when the market becomes more comfortable that inflation has actually started to fall. And then that's the trade, I think, with share prices in a lot of those sectors, the mid-cap down 30-40%, you could see a very, very swift reversal of that underperformance in the second half. But I think it's definitely FTSE 100 for the first sort of 3 to 4 months of 2023.
Alan, to what extent are geopolitics priced into the market right now? Not just the war in Ukraine, but by extension, Taiwan as well.
I always say it's never priced into the market. And as we've seen in 2022, events can clearly destabilize the market. So I think, yes, geopolitics will continue to play an important part in 2023. And clearly the crisis in Ukraine and what Vladimir Putin does is going to be front and center in terms of how the market's going to think about it. And as you said, also China and Taiwan and the saber rattling we've seen more recently there. But I think, markets always have this level of geopolitical uncertainty, although I accept that it is probably more heightened now than it's probably been in the last 10 years. The market sort of seems to take it in its stride ultimately, doesn't it? And I think we'll see that in 2023.
Well, and Alan, in the UK specifically, it hasn't been just about geopolitics, but frankly, very volatile domestic politics as well. How confident are you about that story and the fiscal story in the year ahead?
I think that you're right. After the September and October wobble, I think that the politicians have got a very clear narrative to stay off the front pages of the papers as much as is possible in 2023. So I do think we get a greater level of stability coming out of the political landscape in 2023 in the UK. And I think the ability of that to destabilize the UK domestic market, hopefully, will be less evident in 23 than it's clearly been in 2022, and it really was the big driver of certainly, sterling dollar rate hitting 103.8 after the mini budget.
Yeah, I remember that one quite well. Just one of many FX episodes that took us all by surprise, or at least made us catch our breath this year. Alan Custis of Lazard Asset Management, thank you so much for joining us, and Happy New Year to you. Guy.
So, Kailey, coming up, are debt investors actually growing more confident in the Fed's ability to contain inflation? We're going to discuss that very issue with Bloomberg's Editor-In-Chief Emeritus, Matt Winkler, next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Stay tuned later today for an interview with Max Baucus.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. Anna Edwards is off and Kailey Leinz on her way to set, joining Matt Miller and Lisa Abramowitz for Surveillance in the next hour. We're very lucky to have very special guests talking about the debt market. Contrary to popular belief, debt investors are growing more confident in the Fed's ability to contain inflation. Matt Winkler, Bloomberg Editor-In-Chief Emeritus, joins us now to talk a little bit about his latest column. Matt, thank you as always for waking up early for us. We've been talking a lot on this show about the big themes of 2022, and one of them has been that the Fed is behind the curve. In your opinion, have they caught up?
They were never behind the curve, and that is something that the bond market said at this time last year, continued to show it through various kinds of, what we would call trades that are the most evident, if you like, example of what millions of people who are investing every day, the people with the most at stake, and they never believed the Fed was going to lose the battle to contain inflation. And of course, what we've seen over the past year is that the Fed did more in less time to tighten credit. And here we are a year from when everybody said it was behind the curve, and the Fed is actually on the path to containing inflation.
Is it still in some ways leading the pack when it's compared to emerging market central banks or the ECB or the BOJ? One of the concerns this year was that perhaps some of these EM central banks had gotten ahead of the Fed in calling that. Are they still the leader of the pack?
Very much so. I mean, if you look at the bond market's performance, U.S. bonds have outperformed the world this year. So that's one measure of where the Fed is, okay? The U.S. bond market has outperformed not only the world, but it's outperformed all of the markets in the group of 7 countries. The second thing is, if you look at inflation, U.S. inflation is one of the lowest among the OECD economies. So those two things together tell you the Fed was never not in control of what was happening.
Matt, good morning. It's Guy. Let's talk about what happens next. The Fed is telling us that they are going to hike rates, so let's call it circa 5%, and then leave those rates there. The market is saying, not so fast. We expect you to be cutting by the back end of next year. Is the danger now that the Fed, having been potentially behind, is now potentially ahead of where the market expects?
Well, we're going to find out. We don't know. The bond market has put its, if you like, reputation and fortune in the belief that inflation a year from now will be very close to what the Fed considers to be its target. The Fed is saying at the moment, right now, that wage price pressures are too high. So it's going to not only keep rates elevated, it may in fact increase them. The Fed may find out that its credit tightening, which always has a lag effect, will prove to be more effective sooner than later. We don't know. But the bond market and the Fed are not really that far apart. The Fed says we're going to do whatever it takes to contain inflation, and the bond market is saying, we believe you. We just think you may get it done sooner than later.
So is Jay Powell Burns or Volcker, do you think?
Oh, he's very much Jay Powell, actually. He's neither Burns, who lost control completely, and Volcker, was dealing with a very different environment than the one that Powell is. And what I mean by that is, inflation as high as it got this year in June, 9.1% or so. It was never the runaway inflation that Paul Volcker had to deal with. So Powell is really dealing with a totally different environment, and he's his own man.
Well, Matt, let's talk about the Fed cuts that Guy was just referencing, the ones that are priced into the market for the back half of the year. Ira Jersey, our Bloomberg Intelligence chief rate strategist, says it's capping yields at the moment because those cuts are priced in. A lot of the consensus when you talk about with bond strategists say the market is completely wrong. Fed cuts aren't going to be really in the Fed's future because they're trying to tackle inflation. They're not going to use it. But Chair Powell has said that the risk of overdoing it is cushioned by the ability to cut rates when they need to. So why is that call so wrong?
I don't know if it's wrong. I mean, look, here's what we're dealing with. A lot of people in June, a lot of people in July, a lot of people in August were saying inflation is out of control. You've had many guests who have said that over and over again. As it turns out, we have seen inflation since August dramatically decelerate from where it's been. And I wouldn't say that was a consensus expectation or call, except in the bond market.
Okay.
That's the only place where you saw it.
Well, Matt Winkler, Bloomberg Editor-In-Chief Emeritus, waking up early to talk of the Federal Reserve. He deserves a special medal for that, in my opinion. We thank you, as always, for your time and your insight. Coming up on the show, New York's first legal marijuana dispensary is open for business. We're going to get the details next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Guy Johnson in London. Anna Edwards is off today. Kailey Leinz on her way to join Matt Miller and Lisa Abramowitz for surveillance in the next hour. In the meantime, New York's first legal marijuana dispensary opened its doors yesterday. And Matt Miller, he was there. This is his report. Take a listen.
This is exciting. For the first time ever, you can buy weed recreationally, legally in New York State. I'm downtown right now in Greenwich Village, actually on the corner of Astor Place and Broadway, and I'm in a Housing Works. It's the first dispensary to open up with the new New York license system. They're selling 100 products from 6 brands, and all of the proceeds are going to go to charity, to help the homeless, to help people with HIV, what you typically know from Housing Works. In total, 8 nonprofits have been given licenses by New York State to sell weed recreationally, and another 28 individuals who are either incarcerated because of the war on drugs, or had a family member or from a community that was affected by the war on drugs. Those people are going to be allowed to make money, and it's obviously a very big business. In fact, Housing Works says they want to make about $1 million in top-line revenue in the first year, but it looks like they're going to do that in a couple of weeks, maybe a month max. In terms of the tax revenue, New York State wants to make $1.25 billion over the next 6 years. There certainly seems to be demand for that. There's a line around the block. Now, there are a few headwinds. Of course, a lot of illegal dispensaries have opened up, you must have noticed, and there are weed trucks everywhere. Those are going to be shut down by the Office of Cannabis Management and the New York Police. The other problem is you have to have cash or a debit card. You can't use a credit card because it's still federally illegal. And on that note, they also can't import any weed from California or Colorado or other states where it's legal because it can't cross state lines. So they have to get it from New York-sourced farms. They've given out a total of 261 licenses to farms, and a lot of those are also minority-owned businesses, female-owned businesses, businesses that are owned by people who are negatively impacted by the war on drugs. And this is how New York is trying to make that better, right that wrong, as well as raise revenue for schools and for nonprofits. I'm Matt Miller. This is Bloomberg.
Well, Matt Miller there with a very excited report on the very first dispensary, guy. It's pretty interesting, though. It's coming at such a crucial time because New York is joining about 24 other states to do this, where they're only giving retail licenses, like Matt said, to nonprofits, people with a cause at the moment. And I think that's a really interesting way to tackle this issue at a time when you do have this kind of divergence between the legality of it between the state and the federal level.
Yeah, we need to have a conversation with Matt Miller about his Christmas jumper selection, but we'll talk about that maybe offline. Yeah, if you think about it, this is the thin end of the wedge. This is how it starts, but ultimately this is an industry that will grow and grow and grow. And I think about it in the same way as I think about what is happening with gambling. States need revenue. There are some fairly clear ways that they can do that. Gambling's one, potentially legalizing marijuana is another. And I think this is going to be a theme that is going to continue to sweep across America.
It's going to sweep across America, and I have to say the timing, once again, is pretty interesting because, look, we are heading into 2023. The election is coming in 2024, the U.S. presidential election, which, once again, could change the way that the entire U.S. government is really made up. So if you are starting to see more and more pressure on the federal government to actually legalize marijuana, what happens when you have a brand new administration in the White House? I think that could actually complicate things even more for a lot of these businesses who are looking to kind of navigate.
Yeah, I think it is going to be tough to navigate, and again, I come back to the gambling industry, which is facing similar challenges as well. But demand is going to be huge, and clearly it is going to outstrip supply. So I'm fascinated to see ultimately how this all evolves and what pricing looks like. Maybe we're going to see inflation or deflation. I don't know which.
Well, either one. And I think following in that suit, when you made that gambling comparison, taxation becomes a big part of that as well. If you are sure about the surge in demand, you're probably going to be sure that you can make a pretty penny off of it as well. So let's see how the states react. It'll be an interesting couple of years.
Absolutely. It's going to be all about fiscal next year. We're going to be watching the monetary policy story. We're going to be watching how these markets. That wraps things up. Thank you for watching this year. We've really appreciated you joining us so early. This was the early edition of Surveillance. Ahead, Lisa, Matt, and Kailey co-hosting today. Michael Purvis of Talonback Capital is going to be joining them. It's going to be a great conversation, some great guests. Have a happy new year. This is Bloomberg.